Remember back in March 2022 when silver prices briefly hit almost $27 an ounce? Most people just brushed it off as a temporary blip caused by the conflict in Ukraine. Prices went back down, the news cycle moved on, and that was that. But what if that quick spike wasn't just random noise? What if it was a sign of a huge fundamental change happening right under our noses, a change that's been building for over a decade? Some traders are now seriously talking about the possibility of triple-digit silver prices. To understand how they got there, we need to look at what's really been happening with silver for the last 15 years. Silver has always been a weird one. It's not just a shiny metal people hoard like gold. About half of all the silver that gets mined is used up in industry and never comes back. But it's also not easily replaceable, like copper or aluminum. For a lot of high-tech stuff, nothing conducts electricity and heat better than silver. This split personality creates some very strange market dynamics. The Silver Institute, which keeps track of all this stuff, pointed out a massive shift starting in 2020. For the first time in a long time, the amount of silver being used by industries started growing faster than miners could dig it out of the ground. In 2020, industries used 508 million ounces. By 2022, that number had jumped to over 556 million. But here's the catch. The amount of silver being mined has been stuck. It actually peaked back in 2016 at around 900 million ounces and has been hovering around 822 million ounces ever since. This growing gap between what we use and what we can find is a real structural problem. You might think, well, if prices go up, miners will just dig up more silver. But it's not that simple. See, most silver isn't mined on its own. About 70% of it is just a byproduct. When a company is mining for zinc, lead, or copper, they get some silver along with it, whether they want it or not. This means the supply of silver really depends on the demand for these other industrial metals, not on the price of silver itself. And here's where things get even trickier. Between 2010 and 2020, a whole bunch of major mines that produced these base metals just ran out of stuff to dig up and had to close. Take the Cannington mine in Australia. It used to be the biggest silver producer in the world. In 2007, they pulled out 36 million ounces. By 2020, right before they shut down, that was down to just 14 million. It's the same story at other huge mines in Alaska, Mexico, and Peru. The quality of the ore is getting worse. Geologists have known this for a while. The really rich, easy-to-get silver deposits are mostly gone. The U.S. Geological Survey confirmed this in 2023. They found that back in 1990, you'd get about 250 grams of silver for every ton of rock you processed. By 2020, that number had dropped to just 50 grams per ton. That's a 5-fold decrease. It means miners have to process 5 times more rock to get the same amount of silver. This uses way more energy, more water, and has a bigger impact on the environment. So when energy prices went through the roof in 2021 and 2022, it hit silver miners especially hard, making it even more expensive to produce. At the exact same time that supply was getting squeezed, demand from certain industries just exploded. The biggest new player on the block is the solar industry. Every single solar panel needs about 20 grams of silver paste to collect the electricity it generates. And with governments all over the world pushing for renewable energy, solar panel installations have gone ballistic. The International Energy Agency reported that in 2010, the world had about 40 gigawatts of solar capacity. By the end of 2022, that was 392 gigawatts. The Silver Institute calculated that solar panels used 113 million ounces of silver in 2021, and that jumped to 140 million in 2022. And this trend isn't slowing down. Europe has a plan to install 600 gigawatts of solar by 2030. China is aiming for 200 gigawatts of wind and solar combined. And in the US, the Inflation Reduction Act is pouring hundreds of billions of dollars into clean energy, a huge chunk of which will go to solar. Even with conservative estimates, these goals mean the solar industry alone will need over 150 million ounces of silver every year by 2025. That's a massive, consistent drain on supply that didn't exist a decade ago. Then there are electric vehicles. People don't talk about this as much in the precious metals world, but it's a big deal. Each EV uses between 25 and 50 grams of silver. While that's less than a solar panel, the sheer number of cars being made is what matters. Global EV sales went from 6.6 million in 2021 to 10.5 million in 2022. And many countries are banning gas-powered cars completely in the next decade or so. The UK by 2030, the EU and California by 2035. If we hit 30 million EVs a year by 2030, which is a pretty cautious guess, that's another 35 to 50 million ounces of silver demand every single year, just from cars. And what about good old electronics? The demand there hasn't gone away. Even though our gadgets are getting smaller, the boom in semiconductors, 5G infrastructure, and all our connected devices has kept demand steady at around 240 million ounces a year. Plus, with the US passing the CHIPS Act to boost semiconductor manufacturing, and Europe and Asia doing the same, that demand is locked in for the foreseeable future. So what does this all mean? We have a situation where the supply of silver is constrained by geology and the economics of base metal mining. It's getting harder and more expensive to pull it out of the ground. At the same time, demand is being supercharged by unstoppable global trends like the green energy transition and electrification. This isn't a temporary spike. It's a structural deficit where we are consistently using more silver than we are producing. When you have inflexible supply and rapidly growing non-negotiable demand, prices have to adjust. The question is no longer if silver prices will rise, but by how much. What's really pushing silver demand isn't just the economy, it's policy. Governments around the world are making laws, offering subsidies, and setting rules that require more silver to be used. Think about solar panels. A manufacturer can't just decide to use less silver if the price goes up. The basic physics of how they work demands it, and right now, there's no commercially viable alternative. While researchers are looking for silver-free solar cells, nothing has reached mass production yet. This creates a kind of forced, non-negotiable demand that grows as green energy policies expand. At the same time, the safety nets we used to have for supply are vanishing. Government stockpiles, which acted as a relief valve in the past, are mostly gone. The United States sold off its strategic reserves decades ago. China, once a huge holder of silver, flipped to being a net importer back in 2007 and has stayed that way. And India, the world's biggest silver consumer for jewelry and religious items, imported a massive 7,800 tons in 2022 alone. This tells you that national reserves aren't coming to the rescue. So where do we look next? What about the public inventories, the silver we can actually see and track? Well, those are shrinking too. Take the COMEX silver warehouses, for example. Their publicly reported stocks fell from 403 million ounces in March 2021 down to 268 million ounces by September 2022. That's a one-third drop in just 18 months. Similar trends were seen in London's major vaults. Now, these inventories are just a fraction of all the silver in the world, but the trend is clear. The amount of readily available physical silver is tightening. This is where some traders started building a compelling mathematical case for much higher silver prices. They looked at the situation and saw an industrial metal with demand being supercharged by government policies. They saw supply struggling to keep up because you can't just magically create new mines overnight. They saw government reserves depleted and exchange inventories draining. The question they started asking wasn't if silver would reach $100, but what price would actually be needed to balance this intense supply and demand squeeze. Their analysis, based on historical patterns in commodity markets, suggested prices far, far above the $20 to $25 range we saw for much of 2022 and 2023. So when you hear traders say the math supports higher silver prices, they're not just guessing. They're referring to specific calculations based on supply and demand accounting and how prices have behaved in the past during similar deficits. This isn't wild speculation. It's a deep dive into documented patterns from commodity markets over the last century. To really grasp this, we need to look at what happened in previous times when a physical commodity ran into a long-term structural deficit. Let's look at the numbers. The Silver Institute, which has been publishing the World Silver Survey since 1990, provides the most reliable data out there. Their 2023 report was a bombshell. It showed that in 2022, the silver market had a physical deficit of 237.7 million ounces. That means total demand from every sector, industry, jewelry, coins, bars, you name it, exceeded all the supply from mines, recycling, and government sales by almost 238 million ounces. To put that in perspective, that deficit was about 20% of the total annual supply. In the world of commodities, that is an enormous shortfall. And here's the crucial part. It wasn't a one-off event. The Institute's data showed this was the third consecutive year of deficits. We had a 51.8 million ounce deficit in 2020 and a 186.4 million ounce deficit in 2021. So over 3 years, the total deficit was about 476 million ounces. That suggests something much bigger than a simple market cycle is at play. For a bit more context, think about the COMEX registered inventory. That's the silver available for immediate delivery. In early 2023, it was only about 45 million ounces. The 3-year deficit was more than 10 times that amount. This raises a critical question. If demand was so much higher than new supply, where did all that silver come from? The only possible answer is from existing stockpiles, the above-ground inventories held privately or in exchange warehouses. When you see those stockpiles being drawn down year after year, basic economics tells you what has to happen next. The price must rise. It has to go up to either encourage more supply, which is hard, or to reduce demand, a process known as demand destruction. So the question the traders were asking was, how high does the price need to go to bring the market back into balance? History gives us some powerful examples. Let AS go back to the period between 1971 and 1980. Silver was in a structural deficit back then too. Industrial demand was growing, and government stockpile sales were winding down. According to data from the CPM Group, a commodities research firm, the total deficits during that decade added up to about 1.4 billion ounces. And what did the price do? It skyrocketed. Silver went from $1.50 per ounce in 1971 to nearly $50 per ounce in January 1980. That is a 300% increase in 9 years. Now, it's true that the very peak in 1980 was fueled by the Hunt brothers trying to corner the market. But even before their most intense speculation kicked in, the price had already hit $35 an ounce by late 1979. That's still a 2,200% rise, driven mostly by the fundamental imbalance between supply and demand. This isn't unique to silver either. A similar pattern played out in the copper market. Copper entered a long-term deficit in 2003 as China's industrial boom took off, while new mine supply was slow to respond. Between 2003 and 2008, copper prices shot up from around 70 cents a pound to $4 a pound, a 470% increase. Prices only stabilized when new mines in Chile, Peru, and Congo finally came online and boosted supply. The key takeaway here is the time lag. It took about 5 years for supply to catch up to demand because financing, permitting, and building a new mine is a long and expensive process. This history is why a sustained supply deficit is such a powerful indicator for traders. They see the deficit numbers for silver, they look at the depleted inventories, and they compare it to historical precedents like silver in the 70s or copper in the 2000s. The conclusion they draw is that the current price doesn't reflect the severity of the underlying physical market tightness. The math, based on these historical patterns, suggests that a significant price adjustment is not just possible but necessary to balance the market. It's a compelling argument rooted in data, history, and the fundamental laws of supply and demand. Let's talk about what happens when demand for something just keeps outstripping supply. A really wild example is uranium. Back in the 90s, there was so much of it that prices were stuck below $10 a pound. But then, starting around 2003, a boom in nuclear power plant construction flipped the script. Suddenly, there wasn't enough to go around. What happened next was insane. The price of uranium shot up from $10 a pound in 2003 to a staggering $137 by June 2007. That's a 1,270% increase in just 4 years. And keep in mind, uranium is just an industrial commodity. It's not like gold or silver that people think of as money. The price spike only ended when new mines in Kazakhstan came online and utilities started selling off their stockpiles. This history lesson is crucial because it shows what can happen when a physical commodity faces a long-term supply deficit. Prices can go absolutely parabolic until one of 3 things happens. New supply is found, demand collapses, or stockpiles are sold off. The bigger and longer the deficit, the crazier the price action. Now, let's apply this framework to silver because its current situation looks eerily similar. Traders are doing the math right now. Silver has been running a supply deficit of about 200 million ounces per year. The total amount of above-ground silver that's actually available to the market, think exchange vaults, government reserves, and private stashes, is estimated to be around 2 billion ounces. If we keep burning through 200 million ounces a year, that available inventory could theoretically be gone in a decade. Of course, we'll never get to zero. Long before the vaults are empty, prices would have to rise dramatically. As stockpiles dwindle, the remaining holders will demand much, much higher prices to part with their silver. So the real question is, what price is needed to balance the market? At what point does it become so expensive that demand falls off, or so profitable that new supply rushes in? Let's look at the supply side first. Getting more silver out of the ground isn't as simple as flipping a switch. According to industry analysis, about a quarter of current silver mines have costs over $20 an ounce. Another quarter operates between $15 and $20. The really low-cost producers, the bottom 50%, are below $15. But these costs keep rising because of higher energy prices and lower quality ore. For a mining company to invest billions into a new project, they don't just need to cover costs. They need to see a fat profit margin, typically a return of over 15% per year. Given all these factors, analysts estimate that we'd need to see silver prices sustained above $30 an ounce just to get companies interested in building major new mines. And even then, there's a huge lag. From the moment a company sees that $30 price and decides to act, it can take 7 to 10 years before a single new ounce of silver is produced. That's a long time to wait when you're already in a deficit. So, if new supply is slow to respond, what about demand? Can't we just use less silver? In some areas, yes, but it's harder than you think. Take solar panels, a huge driver of silver demand. Manufacturers have gotten pretty good at using less silver per panel. The amount has dropped by about a third since 2016. But here now works the catch. The total number of solar panels being installed has grown so fast that the overall demand for silver from the solar industry has still gone up significantly. Unless silver gets so expensive that it makes solar energy uneconomical, which is unlikely given climate policies, that demand seems locked in for the foreseeable future. This brings us to the wild card, investment demand. This is where things get really interesting. Remember 2020 and 2021? Central banks around the world were printing money like there was no tomorrow to deal with the pandemic. The Federal Reserve's balance sheet more than doubled. The European Central Bank did the same. This massive money creation led to a huge spike in inflation, hitting over 9% in the US by mid-2022, the highest in 40 years. What did investors do? They flocked to physical assets as a hedge against their currencies losing value. Global holdings in silver-backed ETFs nearly doubled in less than a year, with investors adding almost 600 million ounces. That's a massive amount of silver taken off the market. History shows that silver tends to do extremely well during inflationary periods. In the late 1970s, when US inflation was averaging over 9%, silver prices grew at an incredible 58% per year. During the commodity boom of the 2000s, silver rose 28% annually. This is because silver has a dual personality. It's a critical industrial metal, so it benefits from economic growth that often comes with inflation, but it's also seen as a store of value, a poor man's gold. And if you think that wave of money printing is over, think again. With massive government deficits and aging populations, some economists believe higher inflation is here to stay. And consider this. In 2022, central banks bought more gold than in any year since 1967. They're diversifying away from traditional currencies. While they don't typically hold silver, private investors and institutions do. They often see silver as a more accessible alternative to gold, one with potentially much greater upside because the entire silver market is so much smaller. A relatively small shift in investment capital into silver can have an outsized impact on its price. So, let's put it all together. We have a structural supply deficit that's draining inventories every year. New mine supply will take years and much higher prices to come online. Industrial demand, especially from the green energy transition, is locked in and growing. And on top of all that, we have the looming threat of persistent inflation, which could trigger another massive wave of investment demand. When you look at all these factors lining up, the case for a dramatic repricing of silver becomes incredibly compelling. Have you ever looked at the silver market and wondered just how big it really is? Now let's put it into perspective. If we take all the silver that's ever been mined and is still above ground, roughly 2 billion ounces, and value it at $25 per ounce, we get a total value of about $50 billion, and that sounds like a lot, right? But now, let's compare that to gold. All the above-ground gold, about 200,000 tons, at a price of $2,000 an ounce, is worth a staggering $13 trillion. This means the entire silver market is worth less than 0.5% of the gold market. What makes this disparity so interesting is that silver has huge industrial applications that gold simply doesn't. It's a critical component in everything from solar panels to electric vehicles and electronics. Because its market is so small compared to gold, even a tiny shift of investment capital can have a massive impact on its price. Think about it this way. What would happen if just a small fraction of global wealth decided to buy silver? Some traders have crunched the numbers. According to Credit Suisse, total global wealth was around $464 trillion in 2022. If just 1% of that, which is $64 trillion, tried to buy silver, the demand would completely overwhelm the available supply at today's prices. Let's be even more conservative. What if only a tenth of that 1%, so $464 billion, flowed into the silver market? That's still nearly 10 times the value of all the above-ground silver in existence. Basic supply and demand tell us that this kind of capital inflow would send prices soaring until a new balance was found. This isn't just wishful thinking. These arguments are built on solid facts. We have verified supply deficits, meaning we're using more silver than we're mining. We can see inventories at major exchanges like the COMEX are declining. We have historical examples of what happens in similar commodity situations. We know the costs to mine silver are rising, and we see government policies pushing for green energy, which requires more silver. And on top of all that, we have monetary conditions that have historically driven people towards precious metals. None of this guarantees that silver will hit $100 an ounce. But it shows why many market watchers believe such a price is mathematically possible if current trends continue. While the industrial demand for silver paints a compelling picture, the monetary and fiscal landscape provides an even stronger argument for a potential price surge. To really grasp this, we need to rewind the clock to the 2008 financial crisis. On November 25th, 2008, the Federal Reserve made a groundbreaking announcement. It was launching its first ever quantitative easing program, or QE, committing to buy $600 billion in mortgage-backed securities. This was a radical move. Never before in peacetime had the U.S. central bank directly purchased assets like this to pump money into the economy. At the time, Fed Chairman Ben Bernanke called it a necessary evil to prevent a total economic collapse, but he admitted the long-term consequences were unknown. That initial $600 billion was just the beginning. By the time the Fed wrapped up its third round of QE in October 2014, its balance sheet had exploded from $870 billion in 2007 to a massive $4.5 trillion. That's a five-fold increase in just 7 years. And it wasn't just the U.S. Central banks in Europe, Japan, and the UK all followed suit, creating trillions of new dollars, euros, yen, and pounds out of thin air. According to classic economic theory, printing this much money should have led to runaway inflation, but for years, it didn't. Between 2009 and 2019, inflation in developed countries stayed surprisingly low, rarely climbing above 2%. This led many economists and policymakers to believe that the old rules no longer applied. They thought factors like globalization and technology had fundamentally changed how inflation worked. And then 2020 happened. The COVID-19 pandemic triggered economic shutdowns around the world, and governments responded with fiscal stimulus on a scale never seen before in peacetime. In the United States, the CARES Act, the Consolidated Appropriations Act, and the American Rescue Plan together unleashed $5 trillion of spending. That's nearly a quarter of the entire U.S. economy, sent out as direct payments, unemployment benefits, and business loans. So, how did the government pay for all of this without raising taxes? It issued a mountain of new debt. And who bought a large portion of that debt? The Federal Reserve, through a renewed and even larger quantitative easing program. The Fed's balance sheet, which had started to shrink, suddenly reversed course. It ballooned from $4.2 trillion in March 2020 to a mind-boggling $8.8 trillion by April 2022. This pattern was repeated across the globe. Total government debt in developed economies jumped by $10 trillion in just 2 years. By May 2023, U.S. federal debt held by the public hit $24.5 trillion. That's 97% of the entire country's GDP, a level not seen since the end of World War II. And the scary part? There's no sign of this trend reversing. The Congressional Budget Office projects that U.S. debt will surpass 100% of GDP within a few years and continue climbing from there, even without another major crisis. Now, here's where it gets really tricky. For years, all this debt was manageable because interest rates were near zero. But when inflation finally did arrive with a vengeance, the Federal Reserve was forced to act. Starting in March 2022, the Fed began aggressively raising interest rates from near zero to 5.5% by July 2023. This caused the cost of servicing the government's massive debt to explode. The interest payments alone on the U.S. national debt were projected to reach $663 billion in 2023 and are expected to soar past $1.4 trillion annually within a decade. This creates a dangerous feedback loop. Higher interest payments mean larger deficits, which means more debt has to be issued, which in turn could push interest rates even higher. It's an unsustainable path. So how does all of this connect back to silver? Historically, during times of major monetary upheaval, when confidence in government-issued currency begins to wane, people turn to hard assets like gold and silver to protect their wealth. These metals have been money for thousands of years, and can it be printed into oblivion by a central bank? The unprecedented levels of debt and currency creation we've seen over the last 15 years have set the stage for exactly this kind of scenario. The combination of silver's tight industrial supply and demand, its tiny market size, and a global financial system drowning in debt creates a powerful case for its future. As investors and even nations begin to look for alternatives to paper currencies that are losing purchasing power, the relatively small silver market could experience an incredible influx of capital. We've seen how even a small percentage of global wealth moving into silver could mathematically overwhelm the available supply. When you factor in the growing instability of the global monetary system, the argument becomes even more compelling. The question is not if these trends will have an impact, but when and by how much. Thanks for watching, and be sure to subscribe for more insights into the markets. Have you ever wondered what happens when a country's debt spirals out of control? It's not just a headline, it's a serious economic question with real-world consequences, and the United States is currently providing a fascinating case study. Let's break it down. In the 2023 fiscal year, U.S. defense spending was a massive $820 billion. That's a huge number, right? But here's the shocker. The interest payments on the national debt were getting dangerously close to that same amount. Projections even show that by 2025, the money we spend just on interest could be more than our entire defense budget. This is what economists call a fiscal trap. Imagine you're paying off a credit card. The more debt you have, the higher your interest payment. If you have to borrow more money just to make that interest payment, your debt gets even bigger and the cycle repeats. That's the trap. So, how does a government get out of this? History shows there are really only a few options, and none of them are pretty. First, they can raise taxes dramatically. Second, they can slash spending on essential services. Both of these are politically explosive and can hurt the economy. A third option is to restructure the debt, which basically means defaulting or telling your creditors you can't pay them back in full. That move shatters a country's credibility for years to come. Then there's the fourth option, the one that's been used most often throughout history. Print more money. This devalues the currency, making the old debt cheaper to pay back in real terms. It's a hidden tax on everyone who holds that currency. A chilling example of this is post-World War I Germany. Burdened with massive war reparations, the Weimar government couldn't raise taxes or cut spending enough without causing chaos. So they turned on the printing presses. In just 2 years, from 1920 to 1922, the German money supply increased sixfold. At first, prices rose slowly, then they exploded. By November 1923, a loaf of bread that cost less than 1 mark before the war cost over 200 billion marks. This hyperinflation wiped out the savings of the middle class and fueled the political instability that led to extremism. Now, you might be thinking, that could never happen today. Our financial systems are much more advanced. And you're right, we have more safeguards. But the basic math of debt hasn't changed. When debt payments start eating up a huge chunk of your income, you're forced to make tough choices. In 2023, the U.S. federal government collected about $4.9 trillion in revenue. If interest payments hit the projected $1.4 trillion by 2033, that means nearly 30% of all tax money collected would go straight to interest. That's more than double the percentage from 2023. A system like that is only sustainable as long as the people lending you the money believe your currency will hold its value. This is where precious metals like gold and silver come into the picture. They have a long history of being a safe haven when people lose faith in paper money. Look at the 1970s. U.S. inflation was high, averaging over 7% a year, and budget deficits were growing. What happened to gold? It skyrocketed from $35 an ounce in 1970 to $850 an ounce by 1980. Silver's rise was even more staggering, going from $1.50 to nearly $50 an ounce in the same period. This happened right after President Nixon closed the gold window in 1971. That move ended the U.S. dollar's direct convertibility to gold. It was meant to stabilize the dollar, but in reality, it removed the final restraint on money printing, and the prices of precious metals took off. An interesting thing happened with the relationship between gold and silver back then. The gold to silver ratio, which is how many ounces of silver it takes to buy 1 ounce of gold, hit a low of 17 to 1. Historically, that ratio has been much higher, closer to 50 to 1. Fast forward to late 2023, and the ratio was hovering around 80 to 1, with gold near $2,000 and silver around $25. Let's do some simple math here. These aren't predictions, just observations based on historical patterns. If that ratio just went back to its historical average of 50 to 1, with gold at $2,000, silver would be at $40 an ounce. If gold were to climb to $3,000, silver would be 60. Now, what if the ratio revisited its 1980 extreme of 17 to 1? With gold at $2,000, silver would be over $117. At $3,000 gold, that implies silver at $176. Again, this is just math based on historical precedent, but the conditions that caused these shifts in the past, rising debt, budget deficits, and inflation concerns, are all very much present today. And it's not just individuals who are noticing. Let's look at what the biggest players in the financial world are doing: central banks. According to the World Gold Council, between 2010 and 2024, central banks around the globe went on a gold buying spree, purchasing over 6,000 tons. The year 2022 saw the single largest purchase since 1967. Who's doing the buying? Many of the buyers are nations looking to become less dependent on the US dollar. At the same time, these countries were buying gold. What were they selling? US Treasury bonds, the very debt we've been talking about. China, for instance, reduced its holdings of US debt by 34% from its peak. Other major foreign holders also trimmed their positions. In total, while the U.S. was adding over $10 trillion in new debt, major foreign central banks were offloading hundreds of billions of dollars worth of it. Think about that for a second. They are selling an asset that pays interest, U.S. debt, to buy an asset that pays no interest, gold. This isn't a short-term trade. Central banks make strategic, multi-decade decisions. This shift strongly suggests a changing perception about the long-term stability and value of the U.S. dollar and its debt-based system. So what does all of this mean for silver? If the global financial system comes under stress, whether from inflation, currency volatility, or crisis of confidence in government debt, investors will rush to find safe alternatives. Because the silver market is much smaller than the gold market, even a small percentage of that money flowing into silver could have a dramatic impact on its price. Silver isn't just a monetary metal, it's also critical for industries like solar panels and electronics, and its supply is tight. Markets can often seem stable for long periods, even when underlying problems are building up. But history shows that when a tipping point is reached, things can change very, very quickly. We've looked at the fiscal pressures, the historical precedents, and the actions of central banks. The pieces are on the board. Whether they will move and when remains the big question. But the mathematical possibility for a dramatic shift is grounded in measurable facts and documented history. Thanks for watching. If you found this breakdown insightful, don't forget to like this video and subscribe for more deep dives into the forces shaping our world. See you next time.